Welcome to the deep dive.
Great to be here.
Today we're going deep into the UK economy, looking at where things stand right now. Around May 2025, we've got a whole load of recent economic indicators, data points, surveys.
Yeah, there's a lot out there, and our job really is to sift through it all, pull out the key bits, and try to build a clear picture for you.
Exactly. Economic data can feel, well, overwhelming sometimes. But we're going to cut through that noise. We want to get you the crucial insights, the surprising facts, the main trends shaping things right now.
We'll be looking at the headline numbers, growth, inflation, jobs, but also digging into what's driving them. How does the UK stack up internationally? And importantly, what are the experts arguing about? Because they don't always agree.
No, they certainly don't. So we'll tackle this together. We'll cover GDP growth, prices, the job market, interest rates, government borrowing, trade, and also how people and businesses are feeling confidence, retail spending, the housing market, even household debt.
Right, connecting all those dots. Let's get started.
Okay, let's kick off with the big one that caught the headlines recently. GDP growth. The first quarter of 2025.
Yes, that's the logical starting point. Because the news for January to March 2025 was, well, quite a bit better than many people were expecting. A positive surprise, you could say.
Better than expected, so the economy grew more strongly than forecasts predicted.
That's right. Looking at Q1 2025 compared to the last quarter of 2024, GDP, that's the total value of everything produced, it went up by 0.7%.
0.7% in 3 months. How did that break down month by month?
Well, it grew 0.2% in March itself, and that followed a stronger 0.5% rise in February. So you see that momentum building compared to the end of last year. Q4 2024 only saw a growth of about 0.1%.
So quite a significant acceleration from that slow end to 2024. And you said it beat expectations. By how much?
It was a noticeable beat. The Bank of England, for instance, in their May report, they'd only penciled in 0.6% growth for Q1.
Oh.
In a survey of independent forecasters, their average prediction was even lower, just 0.4%. So getting 0.7%, yeah, that was definitely an aha moment. It suggests the economy had a bit more underlying puff than many experts thought at the time.
Interesting. So what was driving this stronger performance? What were the main engines behind that 0.7%?
Two main things really stood out in the data. Output from the services sector, which is huge for the UK economy, and pretty strong export growth.
Okay, let's take services first. How important is that sector?
It's massive. Makes up something like 4/5 of the whole economy. And in Q1 2025, services output grew by 0.7% compared to the previous quarter.
Right.
And if you look back over the whole year, it was up 1.5% compared to Q1 2024. So services were definitely pulling their weight.
That sounds key. Was it just services pushing things forward, or were other areas contributing too?
No, production output also had a pretty healthy quarter. It was up 1.1% compared to Q4 2024. Within that, manufacturing specifically rose by 0.8% over the quarter. Though it's worth noting, manufacturing was actually still down slightly by 0.4% compared to where it was a year earlier.
So a short-term bounce, but still lagging year on year?
Kind of, yes. And construction output was estimated to be, well, basically flat in Q1. That followed some modest growth, 0.3% in Q4 2024. The monthly figures were a bit choppy too. Construction actually grew 0.5% in March, but production output fell 0.7% in that same month.
So even within a good quarter overall, you get these monthly ups and downs. Were there any specific service industries that did particularly well?
Yeah, the data pointed to strong growth in areas like administrative and support services. And maybe more relatable for people listening, retailing also saw growth.
Retailing, that feels significant, especially given all the talk about cost of living pressures.
It does. And there's this interesting little anecdote that came out. The retailers themselves suggested that the surprisingly sunny weather in March actually helped boost sales, got people out and about, maybe.
Huh. So the sunshine literally showed up in the economic data.
Apparently so. A nice reminder that it's not all just abstract numbers. You also mentioned exports were a key driver.
Yes, that was the other main engine you highlighted. What did that look like?
Exports performed really strongly in Q1. Goods exports were up a hefty 5.6% compared to Q4.
Wow, 5.6%.
Yeah, and services exports were also up by a solid 2.0% over the same period. So selling more UK stuff abroad definitely played a big part in that overall 0.7% GDP figure.
Okay, so a strong Q1 for the UK. How did that 0.7% growth compare internationally, say, against other big economies?
Well, putting it in context, the UK's 0.7% was actually higher than Germany's growth in Q1, which was 0.2%.
Right.
It was higher than France, they managed 0.1%, and it was even higher than the US, which actually saw a small contraction, minus 0.1% for the quarter.
So for that specific 3-month period, the UK was actually outperforming several of its major peers. That's quite a turnaround from some previous narratives.
So it certainly provides important context, yes. A picture of relative strength in that particular window.
Of course, we should always add the caveat. With these early GDP figures, they are just the first estimate, right? They can get revised later as more data comes in.
Absolutely. It's the best snapshot we have now, based on the available information, but that 0.7% isn't necessarily set in stone. The final picture for Q1 might shift slightly later on.
Okay, so that's the good news story from Q1. But looking forward, things seem, well, a bit more uncertain. You mentioned earlier that some economists are warning this pace might not last.
That's right. Despite that strong start to the year, there are some pretty significant clouds on the horizon, and some of the more forward-looking indicators are flashing, let's say, caution signals.
What's the Bank of England's take on this? How do they view that strong Q1 figure in light of the outlook?
Well, in their May forecast, they basically said that the 0.7% growth in Q1 was likely significantly above the estimated pace of underlying growth in the economy.
Okay. And what do they think that underlying pace actually is?
They estimated it was probably closer to zero. And looking ahead to Q2, the current quarter, their forecast is for growth to slow right down to just 0.1%.
0.1? Point 0.1? That's a massive drop from 0.7%.
It is. So you have this tension, really strong recent performance, but the official forecast is much more subdued for the immediate future. It suggests that Q1 might have been unusually strong for specific reasons, and perhaps not a reliable guide to the underlying momentum.
And one big factor creating uncertainty now is the announcement of higher American tariffs back in early April. That wasn't really reflected in the Q1 numbers, was it?
No, exactly. The Q1 activity mostly happened before those potential tariffs were announced. So their impact, or even just the fear of their impact, is something that's really only starting to filter through now.
And are we seeing signs of that filtering through already, maybe in those business surveys like the PMI?
Yes, precisely. The Purchasing Managers Index, the PMI, gives us a more up-to-date feel for things. The flash estimates for May, which came out after the tariff news, they paint a more cautious picture, especially for manufacturing.
What did the manufacturing PMI show?
It came in at 45.1 for May. That's actually slightly down from 45.4 in April. And remember, anything below 50 on the PMI indicates contraction.
So manufacturing is still shrinking.
Yes. And businesses reported that both production and new orders were down. Worryingly, they also said staffing levels were falling at the fastest rate in about 5 years.
And are they linking this directly to the tariff situation?
They are. The survey report specifically mentioned a decline in export orders, and it partly attributed this to increased uncertainties, explicitly name-checking the prospective U.S. tariffs. It said these uncertainties have drained confidence among international customers.
Wow. So the mere prospect of tariffs is already hitting manufacturers' order books and making them hesitant to hire, even before anything formally happens.
It seems so. That's the power of uncertainty in business decisions.
What about the services sector? It was the star performer in Q1. How did its PMI look in May?
The services PMI was 50.2 in the May flash estimate. That's actually up a bit from 49.0 in April. April had dipped just below 50, indicating a slight downturn, so 50.2 suggests a marginal return to expansion, just barely above the line.
Okay, so a little better than manufacturing, but hardly booming. Did services see any impact from the trade uncertainty?
Yes, interestingly. Even in services, the May survey reported a fall in exports. Total new work coming from abroad apparently decreased at the fastest pace since way back in February 2021.
That's striking. Export orders falling sharply in services too, not just goods.
It is. It suggests the chill from global trade worries isn't just affecting physical products. And it also makes you look again at that strong Q1 export performance we talked about.
How so?
Well, there's a suggestion now that some of that Q1 strength might have been what's called preemptive trade.
Preemptive trade, meaning what exactly?
Meaning businesses might have rushed to get exports shipped out in Q1, specifically to the U.S. perhaps, before any potential new tariffs could kick in, trying to beat the deadline, so to speak.
Ah, I see. So businesses potentially front-loaded their exports.
That's the theory. The official statisticians even noted an uptick in UK-US trade back in March as a possible sign of this changing trader behavior.
So the strong Q1 export number might not reflect sustainable underlying demand, but more of a temporary surge driven by tariff fears.
It could be, yes.
Ah,
It means we need to be cautious about reading too much into that Q1 export strength when thinking about the future. It might have borrowed activity from later quarters. This really highlights why the outlook feels so uncertain right now, especially around trade.
right. So a real mix of signals, a surprisingly good start to the year, but then these forward-looking indicators and tariff worries pointing to a potential slowdown. Okay, let's switch gears to prices and money inflation and interest rates. This obviously affects everyone.
Yes. And this is another area where we've seen a pretty significant and less welcome recent development. UK inflation took a sharp turn upwards in the latest figures.
Sharp turn upwards, so not just a small increase.
No, it was quite a jump. The Consumer Prices Index, the CPI, its annual rate hit 3.5% in April 2025. That's up quite substantially from 2.6% in March.
3.5%. That's the highest it's been for a while, isn't it?
It is the highest rate since January 2024. So after that long period where inflation was gradually coming down from its peak.
Yeah, that peak was over 11%, wasn't it? October 2022?
That's right, 11.1%.
Yeah.
So it eased back a lot from there, but this latest data shows it's definitely picking up pace again, reversing direction.
What caused that big jump in April specifically?
The single biggest factor was housing and household services. And drilling down into that, it was mainly down to increases in gas and electricity prices.
Ah, the energy price cap change in April.
Exactly. That kicked in, and the overall price of electricity, gas, and other energy items was up 7.5% compared to April last year.
So energy prices are still a big part of the story, but was it just energy driving inflation up?
No, and this is a really important point. We also saw rises in the underlying measures of inflation. Core inflation, that's the one that strips out volatile things like energy and food prices to give a better sense of underlying trends that rose from 3.4% in March to 3.8% in April.
Okay, so broader price pressures seem to be building too.
It looks that way. And services inflation, which policymakers watch very closely because it often reflects domestic wage pressures and tends to be stickier,
Stickier.
yeah, less likely to fall back quickly once it goes up. Services inflation jumped from 4.7% in March to 5.4% in April.
Wow, 5.4%. Why is services inflation considered so significant?
Because services are usually less affected by global things like oil prices
Right.
and more influenced by what's happening domestically, like how much wages are rising and how strong consumer demand is. If services inflation stays high, it can signal that price pressures are becoming more embedded in the UK economy itself, making it harder to get overall inflation back down to that 2% target sustainably. The fact that both core and services inflation went up suggests it's not just an energy story anymore.
How does the UK's current 3.5% inflation rate stack up internationally?
Well, in April 2025, it was noticeably higher than the average across the European Union, which was 2.4%.
Right.
And it was also higher than the Eurozone specifically, where inflation was 2.2% in April.
So the UK is currently experiencing faster price rises than its main European neighbors.
That's what the April comparison shows, yes. Just for context, within the EU, Romania had the highest rate at 4.9%, while France was way down at just 0.9%. Big variations.
Given this recent pickup in inflation, what are the forecasts saying now? Where is it likely to go next?
Most predictions suggest it's going to stay elevated for a bit. The Bank of England's own forecast for May has inflation peaking at 3.5% in the third quarter of this year, so basically staying where it was in April again, driven largely by those energy price effects.
And when do they see it getting back to their 2% target?
Not for a while, actually. Their forecast doesn't see inflation hitting 2% until the first quarter of 2027.
Q1 2027, so still quite a way off.
Yes. A separate survey of independent forecasters is a bit more optimistic for the shorter term, predicting 3.0% by the end of this year, Q4 2025. But still above target.
And those U.S. tariffs we keep mentioning, did the bank think they might add to inflation pressures too?
They did suggest a small effect, yes. They said higher U.S. tariffs would likely weigh slightly on UK inflation. Their forecast included a small upward nudge, maybe 0.2 percentage points extra inflation in 2 years, 0.1 in 3 years. Not huge compared to energy, but another little push upwards.
Okay, so this picture of rising, stickier inflation makes things really tricky for the Bank of England's Monetary Policy Committee, the MPC, when they're deciding on interest rates. What was their latest move?
Well, at their meeting on May 8th, they actually voted to cut the main interest rate, the bank rate, by 0.25 percentage points. That brought it down to 4.25%.
4.25%. That's the lowest the base rate has been for a couple of years, right?
It is, yes. It was the second rate cut this year and the fourth cut they've made in the past 12 months. So it marks a clear shift away from the rate hikes we saw before that.
Why cut rates if inflation just jumped up? What was their reasoning?
Their statement said they felt substantial progress on disinflation had been made over the last couple of years, and that allowed them to make these cuts. But crucially, they also stressed that they believe rates are still in restrictive territory.
Meaning they're still high enough to dampen the economy.
Exactly. High enough to help squeeze out persistent inflationary pressures, as they put it. So they see it as a cautious step, not opening the floodgates.
But it wasn't a simple decision, was it? I heard the committee was quite split on this.
Ah, yes. This is where it gets really fascinating, and you see the expert debate happening live. The vote was actually split three ways. 5 members voted for the 0.25% cut,
Okay.
but 2 members wanted a bigger cut, 0.5%. And another 2 members wanted no cut at all. They voted to keep rates on hold.
Wow. So you had people arguing for faster cuts, people agreeing with the middle path, and people saying, hold on, let's not cut yet, all looking at the same economic data. What were the different arguments?
Well, those arguing for caution, for holding rates steady. That group included the bank's own chief economist. They felt the rate cuts should be cautious. They worried the recent pace of cuts might be running a little too fast, especially given that inflation needs to get all the way back to 2% sustainably. They hinted the MPC might need to, quote, skip a quarterly cut at some point to see how things develop.
So essentially saying, let's pause and see, especially with that inflation jump.
Pretty much. On the flip side, those who wanted a bigger cut, or who generally favor a lower path for rates, they'd argue that rates are still very high and restrictive. They might point to that recent inflation rise being driven by known sort of one-off factors like those pre-announced energy and water bill increases. Their view might be that these expected bumps shouldn't stop the overall process of bringing rates down if the underlying trend is still towards lower inflation.
It really shows how difficult it is to read the economic tea leaves right now, doesn't it? Different interpretations of the same numbers leading to very different policy recommendations.
It absolutely highlights the uncertainty. There's no easy answer when the signals are this mixed.
Now, besides setting interest rates, the Bank of England has also been unwinding its quantitative easing program, QE. Can you remind us what that is and what's happening there?
Sure. QE was basically the bank creating electronic money to buy assets, mostly government bonds, to inject money into the financial system, particularly during crises or downturns. They built up a massive stockpile of these bonds, peaking at $895 billion.
895 billion.
Huge number. Now, they're shrinking that stockpile. It's called quantitative tightening, or QT. By the end of April 2025, the total was down to $620 billion.
Okay.
And the plan is to reduce it by another $100 billion over the year, running up to September 2025. They do this partly by just letting bonds mature and not replacing them, and partly by actively selling some bonds back into the market.
So they're not just cutting rates, they're also slowly pulling some of that QE money back out of the system. How does the Bank of England's stance compare to what other major central banks are doing?
It's a bit of a mixed bag globally. The U.S. Federal Reserve, the Fed, they kept their interest rates unchanged in early May, in a range of 4.25% to 4.50%.
Similar level to the UK, then?
Roughly, yes. And interestingly, the Fed specifically mentioned uncertainty linked to those U.S. trade policy changes the tariffs again as a reason for their caution. They're also slowing down the pace at which they're shrinking their own QE asset holdings.
So the Fed is also sounding cautious, partly because of the trade situation. What about the Eurozone?
The European Central Bank, the ECB, they took a different step in April. They cut their main interest rates by 0.25%, bringing their deposit rate down to 2.25%.
Lower than the UK and US rates?
Yes. And that was actually their 7th rate cut since they started using back in June 2024. Markets generally expect the ECB to keep cutting further.
So we see quite different approaches, the ECB cutting more consistently, while the Bank of England and the Fed seem a bit more hesitant, perhaps reflecting different inflation dynamics or specific concerns like trade policy in the US. How do these central bank decisions affect ordinary people, say with mortgages?
Well, lower central bank rates generally feed through to lower borrowing costs from commercial banks. And we are seeing that. The average interest rate on a new 2-year fixed-rate mortgage in the UK was 4.43% in April 2025.
4.43. How does that compare historically?
That's actually the second lowest average rate we've seen since all the market turmoil after the September 2022 mini budget, so a definite improvement from the peaks.
And there have been reports of some lenders even offering deals below 4% now.
That's right. Competition among lenders seems to be heating up as the bank rate comes down, leading to some sharper pricing. Even the average standard variable rate, the SVR, which people often fall onto after a fix ends, was down a bit year on year, around 7.23% in March. Still high, but moving in the right direction for borrowers.
Okay, that's helpful context on rates and borrowing. Let's move on to another really fundamental area, the job market. Employment, unemployment. What's the latest picture there?
Looking at the data for January to March 2025, the overall employment number was 33.98 million people working in the UK.
34 million almost. How does that compare to a year ago?
It's actually up quite significantly, an increase of 640,000 people in employment compared to the same period last year.
640,000 more jobs. That sounds like a very strong number.
It is a substantial increase. It means the employment rate for people aged 16 to 64 reached 75.0%. That's up from 74.5% a year before, and the rate increased for both men and women.
How does that split between full-time and part-time work?
In that JAMAR period, about 25.4 million were working full-time and roughly 8.6 million part-time. And in terms of status, the vast majority, over 29 million, were employees, while about 4.4 million were self-employed.
Okay, so employment looks pretty robust year on year. What about the other side, unemployment?
The number of people officially unemployed was 1.61 million. Now, that was actually up by 100,000 compared to a year earlier.
Right.
So the unemployment rate ticked up slightly from 4.3% a year ago to 4.5% in January 2025.
That seems a bit counterintuitive. How can employment be up so much, but unemployment also be up?
It usually means the overall size of the labor force, that's everyone who is either working or actively looking for work, has grown over the year. So more people have entered the jobs market. While many of them found jobs, hence the rise in employment, the increase in job seekers slightly outpaced the increase in jobs filled, leading to that small rise in the unemployment rate.
Got it. Is there anything specific to note about younger workers, say 16 to 24-year-olds?
Yes, youth unemployment does continue to be a concern. There were 620,000 unemployed young people in that age group, which is up 59,000 from a year before. Their unemployment rate stood at 14.2%, up from 13.2% a year earlier, so significantly higher than the overall rate.
Okay. And how does the UK's overall 4.5% unemployment rate compare internationally?
Using comparable data for Q1 2025, the UK's rate was a bit higher than Germany's, which is 3.5%, and the US at 4.1%.
Right.
But it was quite a bit lower than France, which is up at 7.3%. The Eurozone average was 6.2%, and the average for the G7 group of major economies was 4.3%.
So kind of middle of the pack for the G7, maybe slightly above average, but below the Eurozone average.
That's a fair summary based on the Q1 figures.
Yeah.
And, of course, you see huge variations elsewhere. Spain, for example, had an unemployment rate close to 11% and youth unemployment over 26%. Just shows the different challenges globally.
Beyond just whether people have jobs, the crucial thing for living standards is wages. Are people's earnings actually keeping up with inflation? What's happening with real wages?
This is a really key question, and the recent data has been, well, relatively positive on this front. Average weekly earnings, excluding bonuses, were 5.6% higher in the 3 months to March 2025 compared to the same time last year.
Okay, 5.6% nominal wage growth. What was inflation over that same period?
Over those specific 3 months, CPI inflation averaged about 2.8%.
Ah, so wage growth running well ahead of inflation then.
Exactly. If you adjust that 5.6% wage growth for the 2.8% inflation, it means real wages, what people can actually buy with their money, excluding bonuses, were 2.6% higher than a year ago.
2.6% real terms increase. That's quite significant.
It is. Including bonuses, the picture was very similar. Nominal pay up 5.5%, real pay up 2.6%. So on average, people's pay packets have been growing faster than prices recently. That's a definite positive for household budgets.
How did pay growth look across the private versus public sectors?
Interestingly, it was almost identical in the 3 months to March. Total pay, before inflation adjustment, grew by 5.4% year on year in both the private sector and the public sector.
And do we have any more detailed figures, say, on hourly pay?
Yes. The detailed survey data, though it relates back to April 2024, gives us a snapshot. The median hourly pay, excluding overtime, for all full-time employees was £18.64.
Yeah.
For men working full-time, the median was £19.24, and for women full-time, it was £17.88. For part-time employees, the overall median was lower at £13.26. Interestingly, for part-timers, the median was slightly higher for women, £13.40, than for men, £13 pounds. But it's important to remember that women are much more likely to work part-time than men.
Right. Those figures give a good sense of the earnings landscape. Okay, let's shift focus now to the government's own financial position, public borrowing, and debt.
Okay. The latest figures cover the financial year that just ended in March 2025. The second estimate suggests the government borrowed $148 billion over that year.
148 billion. How does that stack up against previous years or forecasts?
Well, it was $17 billion more than was borrowed in the 2023-24 financial year. And it was also $11 billion higher than the official forecast that was made just a month before the year ended in March 2025.
So, borrowing came in higher than expected and higher than the year before. What about the total amount of debt the government owes?
The main measure, public sector net debt, reached 95.5% of GDP at the end of April 2025. That's up from 94.8% of GDP a year earlier.
Still very high historically, then.
Yes. There's also a broader measure called Public Sector Net Financial Liabilities, or PSNFL, which looks at the whole government balance sheet. That was 83.5% of GDP at end April, up from 80.2% a year before. So both the annual borrowing and the overall debt pile, relative to the size of the economy, have increased over the past year.
What are the forecasts saying about where borrowing and debt are headed?
Generally, the forecasts predict that the amount the government borrows each year will fall as a percentage of GDP over the next few years.
Okay, so the deficit is expected to shrink relative to the economy.
Yes, but the forecast for the total stock of debt, that 95.5% figure, is projected to remain pretty stable or even edge up slightly as a percentage of GDP over the medium term. This really highlights the ongoing fiscal challenge. Even if annual borrowing comes down, the accumulated debt mountain remains very large.
Right, and that has implications for future spending choices and so on.
Yeah.
Okay, we've covered the domestic economy pretty thoroughly. Let's widen the lens now and look at markets, trade, and the value of the pound internationally. What's been happening in financial markets?
Okay, let's take a snapshot from late May, around May 29th. The FTSE 100 index, the main UK stock market benchmark, closed around 87.16.
How's that been performing?
It's been a bit of a roller coaster recently. It actually hit a record high back in February, just over 8,800. But then it took quite a tumble in April, dropping below 7,700 at one point, its lowest in over a year. So the May level represented a bit of a recovery, up about 3% over the month and up about 7% over the past year. Still below that February peak, though.
Okay, volatile. What about key commodities like oil and gold? They often tell a story about global sentiment.
Definitely. Brent crude oil was trading around $63.50 a barrel in late May. Oil prices have been all over the place. Historically, remember $145 back in 2008, then under $20 in 2020, then back up near $127 in 2022. More recently, it dipped below $60 in April this year for the first time since early 2021. Compared to a month ago, it was pretty flat, but the big story is the year-on-year change. Oil was down 24% compared to May 2024.
A quarter drop in the oil price over the year. That's significant. And gold, often seen as a safe haven.
Gold has had a completely different year. Its price was around $3,300 an ounce in late May. It's been climbing strongly and actually hit an all-time record high just a month earlier in April 2025, over $3,400. Wow. Like oil, it was pretty flat compared to the previous month, but look at the year-on-year change. Gold was up a massive 40% compared to May 2024.
40% increase in gold in 12 months.
Extraordinary, isn't it? That huge jump in gold, especially contrasting with the fall in oil prices and the choppiness in stock markets, it really does suggest a high degree of underlying nervousness or caution in the global financial system. Investors often flock to gold when they're worried about uncertainty or inflation, and its recent performance certainly reflects that.
Very interesting contrast. Now let's look at the UK's trade performance. Goods and services, what's the big picture?
Looking at the full year 2024, the UK exported 873 billion hours worth of goods and services combined. Imports were higher, at 906 billion. So that left an overall trade deficit of 32 billion for the year.
Okay, a deficit overall. How does that break down between goods and services? Because the UK usually runs a surplus on services, right?
That's exactly right. It's a long-standing pattern. In 2024, there was a very large deficit on trade in goods alone, 226 billion. But this was largely offset by a big surplus on trade and services, which came in at 194 billion. So services exports are absolutely vital for balancing the UK's trade books.
And geographically, how does trade with the EU compare to the rest of the world?
In 2024, the UK had a significant trade deficit with the European Union, amounting to 97 billion. But interestingly, it ran a trade surplus with non-EU countries, worth $65 billion.
So the overall deficit is more than accounted for by the imbalance with the EU. What about the most recent trends, say Q1 2025?
In the first 3 months of this year, the overall trade deficit actually narrowed a bit. It fell to $10.6 billion, down from $12.5 billion in the last quarter of 2024. This was because exports grew faster than imports over that period. Exports were up 5% in cash terms, imports up 3.9%.
That narrowing deficit fits with the strong export growth we saw helping the Q1 GDP number.
It does. And again, it's worth keeping that caveat in mind about how much of that Q1 export strength might have been temporary, perhaps linked to that preemptive trade idea.
Right. Now, beyond just goods and services trade, there's the current account. That's a broader measure, including investment income and things, isn't it? What does that show?
Yes, the current account gives the widest picture of the UK's financial flows with the rest of the world. For the full year 2024, the deficit was £76 billion, which works out as 2.7% of GDP. That was actually an improvement on 2023, when the deficit was larger at $95 billion, or 3.5% of GDP.
Okay, so an improvement over the full year.
Yes, but the deficit did widen again in the very last quarter of 2024. It reached $21 billion, or 2.9% of GDP, in Q4, which was up from $12.5 billion, 1.7% of GDP, in Q3. So the picture worsened a bit towards the year end.
Got it. Let's talk about the pound now. Sterling's value on the foreign exchange markets. How has it been doing?
Well, the Sterling Exchange Rate Index, or CRI, which measures the pound against a whole basket of currencies, it actually fell slightly between March and April 2025 by 0.3%, and it had fallen more sharply, 2.2%, the month before that.
So weakening a bit recently.
In those couple of months, yes. But despite that, the index in April was still 2.7% higher than it was a year ago, though it remains quite a long way below its peak value way back in January 2007, about 20% lower, actually.
How has sterling performed against the two big currencies, the US dollar and the euro?
Against the US dollar, sterling actually strengthened between March and April, rising 1.7% to average $1.31. For context, it was briefly up at $1.43 back in 2018 and famously dipped to $1.08 in September 2022. So $1.31 in April was 4.9% higher than a year earlier.
Okay, stronger against the dollar year on year. What about the euro?
Against the euro, sterling weakened between March and April, falling 1.9% to average 1.27. Compared to a year ago, that 1.17 rate was only very slightly higher, just 0.3%.
So the pound's gained quite a bit against the dollar over the last year, but it's been pretty flat against the euro, with some recent weakening against both. And obviously, these exchange rates matter for importers, exporters, and anyone traveling.
Absolutely. They feed directly into costs for businesses and consumers.
Okay, we've crunched through a lot of the hard data: growth, inflation, jobs, finance, trade. Let's shift now to the softer side, the mood music. How are businesses and consumers actually feeling, and how is that showing up in spending or housing decisions?
Yeah, these confidence indicators are really important. They can give us clues about future behavior, sometimes before the official activity numbers reflect it.
What are businesses saying about their expectations for the year ahead?
Well, a survey in mid-May found that, on balance, more businesses expected their performance to improve over the next 12 months than decrease. About 18.4% expected an increase versus 14.7% expecting a decrease. So positive overall, but maybe not wildly optimistic.
Okay. What about manufacturers specifically? We heard earlier their PMI was looking weak.
Yes, and their confidence reflects that. A separate survey of manufacturers in May showed that more of them expected their output to decrease rather than increase in the next 3 months. The balance was negative, and negative 14%. That was worse than the negative 5% balance they reported in April, so it reinforces that cautious, perhaps even pessimistic mood in the manufacturing sector, likely linked to those trade worries.
Right. So manufacturers feeling less confident. What about consumers? How's the public mood?
The main measure here is the GfK Consumer Confidence Index. In May 2025, it rose 3 points to reach negative 20.
Minus 20, so still negative overall.
Yes, the negative score means that pessimists still outnumber optimists regarding the economy and personal finances. But the fact that the index rose by 3 points from April suggests sentiment is actually improving, moving in a less negative direction.
And does that slightly improving consumer mood seem to be translating into actual spending? What are the retail sales figures telling us?
Yes, it looks like it might be. The volume of stuff people bought in shops and online increased by 1.2% between March and April this year. That followed a small 0.1% rise the month before.
Okay, positive growth month on month. What about the longer trend?
Looking over the 3 months to April, sales volumes were up 2.6% compared to the same period last year. and they were up 1.8% compared to the previous 3 months. So a definite upward trend recently.
And the really big comparison point is pre-pandemic levels, right? How do sales volumes look now compared to before COVID hit?
This is a key positive signal. In April 2025, the volume of retail sales was actually 0.3% higher than it was back in February 2020, just before the pandemic lockdowns began.
Ah, so spending volumes have finally climbed back above pre-pandemic levels.
Yes, and it was also the highest level of sales volume seen since way back in July 2022. It really does suggest a fair degree of consumer resilience, despite all the pressures people are out there spending.
Were any particular types of stores driving that growth in April?
Food stores saw a really big jump sales, up 3.9% between March and April. And again, some retailers put this down partly to the good weather boosting supermarket and specialist food shop sales.
Well, I've effect again.
It keeps popping up. Non-food stores overall saw a small fall, -0.7%, mainly due to lower clothing sales. But that was offset somewhat by rises in department stores and household goods stores where, guess what? The weather was also mentioned as helping sales of outdoor items.
It's becoming a running theme. What about online sales? Still a big chunk of the total.
Oh, absolutely. Online sales averaged $2.5 billion a week in April, excluding fuel. That accounted for 26.8% more than a quarter of all retail spending. It shows how that pandemic-driven shift to online has really stuck.
Okay, let's look at the housing market. Always a key indicator. What's happening with prices?
According to the official UK House Price Index, average prices increased by 6.4% in the year leading up to March 2025.
6.4% annual growth. What about month on month?
Seasonally adjusted, prices rose 1.4% between February and March this year.
Was that growth spread evenly across the UK?
No, definitely not. There were big regional differences. Over the year to March, prices grew fastest in the Northeast, Yorkshire and the Humber, and Northern Ireland. Growth was much slower in places like London, Wales, and Scotland.
What about market activity? Are people actually buying and selling? What do mortgage approvals suggest?
Mortgage approvals for buying a house are a good forward indicator. There were just over 64,000 approvals in March 2025. That's up 4% compared to March last year, so activity has picked up from the lows. However, it was down slightly by 1% compared to the previous month, February 2025, so maybe a slight pause in momentum in March.
And are enough new homes being built? What's the picture on house building?
Looking at England, in the last quarter of 2024, the number of new homes completed was actually down 9% compared to the year before, although it was up 2% on the previous quarter. But the number of new homes started showed a massive year-on-year jump, up 52%.
52% increase in housing starts? That sounds huge. Is the building industry suddenly booming?
It looks dramatic, but there's a specific reason for that massive number. It's largely down to what happened the year before. Back in mid-2023, builders rushed to start projects before new building regulations came into force in June 2023.
Ah, so they brought forward lots of starts into that period.
Exactly. That created an artificially high number of starts then, followed by lower numbers in the next couple of quarters. So when you compare Q4 2024 to the relatively low Q4 2023 figure, you get this huge 52% year-on-year increase. It's more of a statistical bounce back from an unusually low base rather than a sudden massive boom in current activity. Starts are up from recent lows, but that 52% needs that context.
Understood. That makes sense of that big figure. Okay, one last key indicator, household debt.
Yes, and this is actually a really interesting and potentially quite positive part of the story. Household debt, measured as a percentage of the disposable income people have, stood at 118.1% in the final quarter of 2024.
118%. Is that high or low compared to the past?
That's the crucial point. It was the lowest level it has been since at least 2007.
Really? Lowest in 17 years.
Yes. Just think back to the period before the financial crisis in Q3 2008. Household debt peaked at over 156% of disposable income. So getting down to 118% represents a very significant reduction in the relative debt burden on households. It's a key positive trend that often gets overlooked amidst worries about the cost of living.
That is a really important piece of context. Households, on average, are less stretched by debt relative to their income than they have been for a long time. Does that mean fewer problems with debt repayment? What about insolvencies?
Individual insolvencies in England and Wales were around 28,500 in the first quarter of 2025. That was actually down slightly on the previous quarter, Q4 2024. However, it was still up by about 2.1% compared to the same quarter a year earlier, so still slightly elevated year on year, even with that lower debt-to-income ratio overall. Trends also varied a bit across the UK nations.
Okay. We have covered an incredible amount of ground there, from GDP and inflation right down to insolvencies and the weather affecting retail sales. It's definitely not a simple picture, is it?
Not at all. It's a really complex mix of signals right now. And the real challenge, and hopefully the value of this kind of deep dive, is trying to piece it all together. Seeing how these different elements, growth, prices, jobs, confidence, debt, how they all interact.
Yeah, like how does that unexpected jump in inflation back in April affect the thinking at the Bank of England, especially when we know the committee setting interest rates was already quite divided?
It absolutely makes their job harder. They'd been cutting rates based on inflation coming down, but then it bounces back up, and particularly those core and services measures look sticky. It definitely strengthens the hand of those on the committee who are arguing for caution, maybe even a pause in cuts. It just adds another layer of uncertainty about where rates go next.
And how do we square that surprisingly strong Q1 GDP growth with the bank's much weaker forecast for Q2 and those gloomy PMI surveys showing falling export orders? Do they contradict each other?
It's a key tension. One way to reconcile it is, as we discussed, maybe Q1 was boosted by some temporary factors, the weather helping retail, that preemptive export surge before tariffs. If those factors were significant, then maybe the underlying economy is weaker, perhaps closer to the bank's view of near-zero growth. In that case, the more recent surveys showing weaker sentiment and orders might be a better guide to where we're heading in Q2. It means we probably shouldn't get too carried away by that single 0.7% Q1 number on its own.
And that point about household debt being at its lowest relative to income since 2007, how important is that in the grand scheme of things? Does it maybe give households a bit more resilience?
I think it could be quite important, yeah. When households aren't quite as stretched by debt repayments relative to their earnings, they potentially have a bit more of a cushion. They might be better able to handle shocks like energy price rises or maybe even wobbles in the job market compared to when debt levels were much higher, like before the 2008 crisis. It could make the consumer side of the economy a bit more robust than it might otherwise be, perhaps helping to offset some of the other headwinds we're seeing.
And finally, bringing in those international comparisons for growth, inflation, unemployment, what picture do they paint of the UK's position?
It's definitely a mixed bag relative to other major economies. Q1 growth was a pocket of relative strength compared to Germany, France, and the US. That was positive. But on the other hand, UK inflation is currently running hotter than the Eurozone average, which is a clear negative, and the unemployment rate is sort of middling higher than Germany or the US, but lower than France. So some areas where the UK looks relatively good, others where the challenges seem more pronounced compared to peers.
Okay, so summing up this whole deep dive, it feels like we have an economy that started 2025 on a surprisingly strong footing, that Q1 GDP growth, retail sales volumes creeping back above pre-pandemic levels, and that really notable improvement in household debt ratios.
Right, definite pockets of strength and resilience there.
But set against that, you've got some pretty significant headwinds and worries. Inflation has bounced back up and looks a bit stickier, making the interest rate outlook very uncertain and dividing the experts. And then there's this big cloud of uncertainty around trade tariffs, which seems to already be hitting business confidence and export plans.
Exactly. It paints a picture of an economy with some underlying robustness, especially perhaps on the consumer side, thanks partly to that lower debt burden, but one that's also quite vulnerable to these external shocks, global trade friction, volatile energy prices, and still facing those longer-term domestic challenges like improving productivity.
Well, hopefully, wading through all that detail has given you, our listener, a much clearer, more nuanced sense of the complex forces shaping the UK economy right now as we see it in May 2025.
Yeah, moving beyond just the simple headlines to understand the connections and the tensions in the data is really key, I think.
Absolutely. And maybe here's a final thought for you to chew on after all that. We've got this mix of signals strong recent growth and that falling household debt on one side, but rising inflation and this tariff uncertainty on the other. Thinking about the next few months, what factor do you think poses the single biggest challenge or maybe even opportunity for the UK economy? Something to mull over.
A very timely question indeed.
That brings us to the end of this deep dive. Thanks for joining us.